You have a great interest rate locked in on your mortgage, but you want to tap into your equity. A home equity line of credit, or HELOC, is probably your best bet. These are versatile financial tools, and in this video I'm going to share everything you need to know to understand how HELOCs work and shop for one with confidence. If you find the information in this video helpful, please like and subscribe. Your positive feedback makes me really happy and helps our channel grow. So what is a home equity line of credit? In essence, it's a revolving line of credit secured to your home or other real estate. It'll feel like having a really large credit card. In fact, some lines even give you a plastic credit card to access funds. Although more commonly, you'll take draws using a checkbook or by going online and transferring funds from the line into your regular bank account. A defining element of a home equity line of credit is that it's usually a second mortgage program. This means it'll get recorded as a second lien against your home behind and subordinate to your existing mortgage. The alternative to a HELOC would be a cash-out refinance, and with a cash-out refinance, you pay off your existing mortgage with a new, bigger mortgage, and the difference less any closing costs is cash back to you. But because a HELOC is separate from your existing loan, you get to leave that existing loan in place just as is, same rate, same payment, same everything. If you have a great rate on your current mortgage and a new loan at market rates would be higher, a HELOC may be the best way to go. That's not to say you can't take out a HELOC if you're lucky enough to own your home outright. You can, and there are instances when it could make sense to use a HELOC to pay off your current mortgage, but it's far, far more common for a HELOC to be a second mortgage. And when thinking about a HELOC versus a refinance, there is a really important concept to consider, which is your blended interest rate. Think of your blended rate as a weighted average of the interest you're paying across all the dollars that you borrow. If you're a visual person, imagine pouring the money you owe on a first mortgage and what you borrow on a HELOC into a bucket and then stirring it all around. If you reached in and grabbed $1, the blended rate is the rate you're paying on that average dollar. And this is especially relevant today because so many of us are locked in at amazingly low rates on our homes. We had this opportunity to refinance during the pandemic. So if your mortgage is locked in at a 2-point-something or a 3-point-something rate, that low rate acts as kind of a counterbalance or ballast to the higher rate you'll probably be paying on a HELOC or a home equity loan. We'll talk about that too. So let's say you wanted to borrow, just as an example, $200,000 to do some remodeling, and you have a $500,000 existing mortgage locked in at a 3.25 rate. Should you refinance or should you take out a HELOC? Let's imagine you could refinance at 6%, but the best rate you could get on a HELOC is 9%. The HELOC kind of sounds like a terrible deal, right? But no, it isn't. It's actually the better deal. Keeping your 3.25 rate and borrowing another $200,000 at 9% works out to a blended rate that's a little below 5%, more than 1% better, a whole lot better than a refinance, and probably with less cost. The blended rate calculation isn't actually a one-time thing. It's a living equation that you're going to want to watch. If you take out a HELOC, keep an eye on interest rates. Interest rates move all the time, and your HELOC is going to likely be at a variable rate too. We'll talk about that a little more in a minute, but you want to refigure that blended rate every so often and compare it to the going rate you could secure on a refinance. If rates dip far enough, you might want to explore refinancing to lock in your rate whenever current rates are at or below your blended rate. If you need help calculating a blended rate, you're welcome to reach out to me. My contact info is in the caption, and I'll help you work out the math and can even set you up with an automatic interest rate alert monitoring that'll alert you, send you an email when an opportunity to refinance at favorable terms comes along. Now, the classic use for a HELOC is to fund home improvements or remodeling, but you can use a HELOC for almost anything. You can consolidate higher rate credit cards and other debt. You can pay tuition, you can pay off student loans, you can even do fun stuff. Maybe your neighbor's selling a shiny Airstream, or there's a cool vintage motorcycle you have your eye on. And don't forget, you can use your HELOC to borrow from your equity to fund the down payment or improvements or outright purchase other real estate. And another great use for a HELOC is nothing. A significant number of my clients set up a HELOC as an emergency reserve, just in case. Could be the best reason to have a HELOC. My partner and I have rental properties, and our HELOC gives us peace of mind that we can cover any surprise repairs or vacancies. Having a HELOC for life's what ifs means you don't have to keep quite as much cash in low interest rate, low yielding emergency funds. So putting more of your assets to work in higher yielding investments is really better for you in the long run. And then the HELOC can cover any needs for quick cash, giving you an alternative to selling investments when the market's down, or maybe selling investments and taking a tax hit. There is a word of caution I want to mention, however. If you're using a HELOC as an emergency fund or for other planned improvements or events, if your home value falls, the fine print in your HELOC agreement will likely give your lender the right to close it to draws. And I saw this happen to someone I met in 2009. They had demolished their kitchen in preparation for a big remodeling project and an addition off the back of their house, and their HELOC was closed to draws after the demolition was done. It was not a good situation. Those were really unusual times, but it's worth keeping that important fine print in mind so something like that doesn't happen to you. And make sure you talk to a tax professional to figure out whether or not you'll be able to write off the interest on your HELOC. Under current IRS rules, the interest paid on mortgages secured to your primary residence or a secondary residence can be deductible on loan balances of up to $750,000 in aggregate. That's across all loans on all properties, but if that is only if the funds borrowed were used to purchase or improve the property. So you may not be able to write off the HELOC interest for the portion that you use to buy that Airstream, for example. HELOC programs can vary quite a bit from lender to lender when it comes to some of the little details because they're generally portfolio products. Most mortgages are securitized. After you close a loan, your lender turns around and sells the loan to investors as bonds. Portfolio lending is different. The lender, which would usually be a bank or credit union, is truly lending you their own money. That gives them a ton of latitude when it comes to making up whatever rules on whatever loans they want. They're lending their own money, but they also may be a little more conservative in their lending rules as a bit of a protection to their interests. The amount you can borrow, or really what you can think of as kind of the maximum credit limit or the credit line you can secure on a HELOC, is based on something called the combined loan to value ratio, or CLTV. Most HELOC programs will let you borrow 80% to maybe 90% of your current property value, but there are programs that offer 95% or 100%. And a couple of unusual programs will allow you to borrow up to 125% of the current value of your home if you're using the funds to make improvements, and the final value, your overall debt, will be no more than 90% of the value of your home as improved after the renovations have been done. To estimate what you can borrow, just multiply your current property value by the CLTV allowed for whatever program you've applied for, and then subtract the balance of your current loan. So for example, if the line you've applied for allows a 90% CLTV, and let's say your home is worth $700,000 and you owe $500,000, the math would go like this. $700,000 times 90% equals $630,000 minus your $500,000 existing loan. You'd have a maximum credit line available of $130,000. Don't be surprised, however, if your lender lowballs your property value a little bit. It's kind of time-honored. Estimating a low value is one way that a portfolio lender can be a little conservative and protect themselves. A HELOC should be relatively cheap to set up. Closing costs are often $1,000 or less. I've seen a lot of instances where they're totally free. Many HELOCs do have an annual fee, which is usually charged directly to the line. $50 to $100 is pretty common. And if you plan on closing the line inside of 3 years, beware that many lines, especially the ones that are free, include an early termination fee. So if you're using the line to, say, fix up your home in preparation for selling it, you'll want to know what the early termination fees are. You're going to wind up paying them. $500 is really common, but I had a client once stuck with, I think, a $2,000 early termination fee. Maybe the best feature of HELOCs is that it's a credit line. You pay no interest on a HELOC until and unless you draw funds from it. Draw what you need when you need it, pay interest on what you owe as you go, and only on the amount you've actually borrowed. If you're using the line for a major remodeling project, like a big kitchen remodel, like the folks wanted to that I talked about before, maybe building an accessory dwelling unit, your interest payments kind of ramp up as construction progresses and you draw more funds to do more work. And that's kind of nice while you're working on a big project. Now, unlike a credit card, a HELOC always has a set period during which you can take draws. This is called, not very creatively, the draw period. 10 years is a very common draw period, but I've seen lines where the window is a lot shorter, as little as 12 months on one HELOC program that's designed to be used as a bridge loan to help move equity from one home to another while you're selling one property and buying another, but buying first. HELOCs have a ton of variability in the minimum monthly payment during the draw period as well. Some credit lines require a payment that's a percentage of the outstanding balance. 1% of the balance is really common, but I've seen as high as 1.5% of the balance. And this is especially common with credit line programs that are offered with credit unions. Do the math. If there's a minimum percentage of the balance required, and you'll notice it can be really steep. If you're planning on a $300,000 remodeling project and you have a 1.5 minimum monthly payment, a 1.5% minimum payment, that could be $4,500 on top of your regular mortgage payment. At the other end of the spectrum are HELOC programs that allow an initial interest-only minimum monthly payment while your line is open to draws. And if you take that same $300,000 at maybe a 9% interest rate, the interest-only payment would be $2,250 a month, literally half as much. I really like those interest-only minimum monthly payments for the cash flow flexibility they offer, but don't forget that if you're only paying interest, you're really treading water and the principal balance is going to stay the same. Once the draw period ends, one of two things will happen. A very few credit lines have a balloon payment due, meaning you owe the balance in full at that time all at once. More commonly, you'll enter what's called the repayment period, where you'll repay installments sufficient to get the loan paid off over a set period of time. You will not be able to take draws anymore. That set time is commonly 10, 15, or 20 years. And if you've been paying an interest-only payment and that you haven't paid any extra on an elective basis, that shift to paying an amortizing payment over 15 or 20 years can be pretty significant. So you want to plan and budget accordingly. And this is another good reason to take any opportunity you have to refinance and pay off your HELOC if interest rates give you that opportunity. HELOCs are really awesome, but there are a couple of drawbacks that you want to think about. First, they're generally a variable interest rate, variable monthly. And like all variable rates, the interest rate you pay is the combination of an index and a margin. The index is the part of the rate that moves, and the margin is a fixed amount that gets added to that index, or if you get lucky, subtracted from that index to determine the rate each month. An index on almost all HELOCs is the prime rate, and a really common margin is 1%. So in lender speak, we would say that would be a HELOC at prime plus 1%. The margin and index get added together every month to determine your rate. Anytime that prime rate changes, your rate will change too. The prime rate changes when the Fed changes rates. So once you've got your HELOC, keep an eye on the headlines every time the Fed meets. And if the Fed raises rates 0.25%, next month your HELOC rate will be 0.25% higher too. As I record this, the prime rate is 8%. So if you had a typical prime plus 1% HELOC, your rate would be 9% today. And if the Fed increases rates at the next meeting by 0.25%, the prime rate would go from 8 to 8.25, and your rate next month would be 8.25, the new prime rate, plus your 1% margin for a rate of 9.25%. Now, if rates ever go crazy like they did in the 1980s, believe it or not, the prime rate, which again is 8 today, was 21.5% in 1981. If your rate eventually your rate will hit a protection, a cap that's built in, a maximum rate that you'll never exceed, no matter how high the prime rate plus your margin goes. These caps are usually really high, almost universally. I see 18%. Borrowing a six-figure sum at 9.25%, Knowing the rate may climb further and wind up in the teens might sound kind of unappealing, and the higher the interest rate goes, the higher your payment will be, especially once the interest-only line switches over to its repayment period. So an antidote to some of this is the HELOC's cousin, a home equity loan. Rather than being a credit line with a variable rate, a home equity loan, or sometimes called HELOan, generally has a fixed rate and a fixed payment and a fixed term. There's no variable rate to worry about, no changes to your monthly payment, and never a balloon payment. But HELOan rates do tend to be higher than first mortgage rates and higher than the rate that you would usually have on that variable rate HELOC. The loan terms are often fairly short. 5, 10, or 15-year terms are most common, but longer terms aren't totally unheard of. I think 20 is the longest I commonly see. The combination of that higher interest rate and shorter loan term can make for a relatively high monthly payment. It's also worth keeping in mind that a HELOan loses some of those variable rate credit line features that are so nice. You're going to get a lump sum of money, you're going to be paying interest on it at a fixed payment right away from day one. So if you're ready to get shopping for a HELOC, I recommend talking to your favorite bank or credit union, and don't be shy about checking a few options, because as I mentioned, terms can vary quite a bit from one lender to another. If you'd like a recommendation for lenders to talk to, you're welcome to reach out to me. I don't fund very many HELOCs for my clients. My company's offerings are pretty limited and don't work for most situations, but because of that, I always like being a good resource, so I keep a list of good resources and good options, and I'm totally happy to hook you up. Again, my contact information is in the caption below. And I want to give you a list of questions you can ask, and I'm going to give you a little jargon so you can sound like a professional when you speak with banks and credit unions and check out home equity line of credit options. So here are the questions to ask. What's the margin? Remember, your rate every month is the prime rate plus or minus something. The something is the margin, so the lower the better on the margin. What are the fees? Aim for free to $1,000 to set up, no more than $100 in annual fees, and no more than $500 in early termination fees if you think you might close the line within the first 3 years. What's the draw period? During the draw period, your credit line acts like a line of credit, like a credit card. That's when you can use it, pay it, use it again. Again, 10 years is really typical. What's the minimum payment during the draw period? I like lines that have the interest-only minimum payment during the draw period for flexibility. And you can call this, if you want to sound like you're a banker, an IO payment. What's the repayment period? This is the period of time you'll have to pay back any balance you owe after the draw period ends. Longer means a lower minimum monthly payment. And you can always pay extra, just like you can always pay extra on the interest-only payment during the draw period. What's the combined loan-to-value ratio? You can call it CLTV. And remember, you multiply your home value by the CLTV and subtract your current loan balance to determine your maximum line. A higher CLTV means a higher credit limit. Now, you may find some lenders offer multiple CLTV options, and the margins will be higher if the CLTV is higher. So you'll have to make a decision as to where you want to find that sweet spot between the credit limit that you can borrow and the interest rate that you're going to wind up paying due to that higher margin. And then, does the line allow you to lock in a fixed rate and payment after taking draws? Some lines offer a really cool hybrid feature. They start out as a HELOC, but then they offer the option to switch some or all or chunks of what you owe over to a fixed rate and payment like a HELOan. Now you're a HELOC expert. If you found this information helpful, please like and subscribe. Thanks so much for watching.